A $10,000 emergency fund in a savings account paying around 0.38% can cost you roughly $350 to $460 a year compared with practical high-yield cash options. That is the ugly math. About $38 of interest before taxes in the low-rate account versus roughly $400 to $500 in a competitive insured alternative. You did the responsible thing, built the cushion, skipped purchases, and your bank still turned your caution into cheap funding. So here is the payoff. You are going to see where emergency cash can sit, what traps to avoid in 2026, and how to stop paying the lazy bank tax without gambling with rent money. This is the annoying part. Your emergency fund might be doing exactly what it is supposed to do and still costing you money. Nothing dramatic happens, your balance does not crash, there is no red chart, no app notification says, "Congratulations, your bank kept most of the benefit." The money just sits there looking responsible, while another insured savings account could have paid you hundreds more. This is not about turning your rent buffer into stocks, crypto, or your cousin's trust me bro business idea. Emergency money is not supposed to become exciting. Exciting is what you buy after the car repair is paid for. This is about a basic question. If your emergency fund is supposed to protect you, why is your bank allowed to treat it like free furniture? A lot of people already did the hard part. They built the fund, they drove the older car, they delayed the phone upgrade, they sent automatic transfers until $5,000 became $8,000, and $8,000 became $10,000. That is the win. Then they left it in the savings account attached to checking because it felt like the adult move. Same bank, same app, same login, same comforting feeling that the money is right there. And that is where the trap becomes so boring that people do not notice it. The default bank account does not steal your money, it just underpays it. Take someone like Lauren in Ohio. She's 38, rents a townhouse, has one car, one aging dog, and a job that feels stable until the company starts saying things like efficiency initiative. Over a few years, she builds a $10,000 emergency fund with tax refund money, small transfers, and one work bonus she wanted to spend on a trip but didn't. She does the thing every financial checklist tells her to do. Then she opens the statement and sees the interest line. $3, not $300, not $30, $3. And the bank presents it like it did something generous. On $10,000, a 0.38% savings account earns about $38 a year before tax. At 4.00%, it earns about $400. At 5.00%, it earns about $500. That means the difference can be around $360 to $460 a year, depending on the rate you can actually get and qualify for. On $20,000, the gap can be closer to $700 to $900. That is no longer cute. That is a real household bill. No, this is not magical free money. Interest is usually taxable. Rates can change. Some accounts have rules. Some headline rates only last a few months or only apply to a small balance. But taxable interest is still better than almost no interest. If your bank gives you $38 and another insured account could have paid $400 or $500, the fact that taxes exist does not make the $38 noble. It just makes the math slightly less fun. APY stands for Annual Percentage Yield. It is the yearly pay rate on your savings after compounding. Think of APY like the price tag for what the bank pays you to keep money there. If one account says, "We will pay you about $38 a year for holding your $10,000, and another insured account says, "We may pay around $400 or $500, that is not a tiny technical detail, that is a household budget line. Second, fear. Emergency money has one job: do not disappear. So when someone says, "Move it," your brain hears, "Risk it." That instinct is fair. Emergency cash should not be treated like a 401k, a brokerage account, or a meme stock bought because someone online typed in all caps. But a high-yield savings account is not a stock. It is not supposed to swing up and down with the market. It is still a savings account, usually with online transfers, daily liquidity, and federal deposit insurance if it is held at an insured institution within the limits. For banks, that usually means FDIC insurance. For credit unions, that usually means NCUA insurance. The common limit is generally up to $250,000 per depositor, per insured institution, per ownership category. In plain English, if you are within the rules and the bank or credit union is properly insured, there is a federal insurance backstop if the institution fails. Third, people confuse access with location. You may need emergency cash available. That does not mean every dollar has to sit in the exact same account as your debit card. There is a difference between I can get this money in 1 to 3 business days and I need the entire $10,000 at an ATM before breakfast. Most emergencies do not require a stack of physical cash at 2 a.m. A flat tire needs a same-day buffer. A prescription needs checking. A credit card paid off immediately or a small transfer. A broken water heater usually comes with an invoice, a card payment, or at least a short window to move funds. Job loss does not spend 6 months of expenses in one morning. You draw it down over time, which means the main reserve can sit somewhere that pays a real rate while still being reachable. So the smarter structure is not all the money in one place. It is a stack. Layer 1, checking. This covers upcoming bills and normal spending, not your entire emergency fund, just the cash that has a job in the next few weeks. Layer 2, instant buffer. This is a small same-bank savings cushion for things that need speed. For many households, that might be $500 to $1,500. If your rent is high, your income is irregular, your car is fragile, or you have kids, maybe that number is larger. This layer is allowed to be boring. It is the cash fire extinguisher. Layer 3, the main emergency reserve. This is the bigger fund, often 3 to 6 months of essential expenses, held in an FDIC insured high-yield savings account, an NCUA insured credit union account, or a federally insured money market deposit account with no monthly fee and reliable transfer access. Because chasing the absolute highest APY can create a different problem. The biggest number on the comparison chart is not always the best account for your life. Some 5.00% offers only apply to the first $5,000. Some require direct deposit. Some require debit card swipes. Some require monthly deposits. Some drop after a promotional period. Some have balance caps, awkward transfer rules, minimums, fees, or withdrawal limits. So, a clean 4.00% account with no monthly maintenance fee, no minimum balance headache, no silly hoops, and transfers that actually work may beat a flashy 5.00% headline if you do not qualify or if most of your money sits above the cap. Here is the practical 2026 filter. Verify insurance first. FDIC for banks, NCUA for credit unions, correct institution name, correct ownership category within coverage limits. If the account is through a fintech, do extra homework on the partner bank setup and the sweep arrangement. If you cannot clearly tell who holds the deposit, do not put your emergency fund there just because the app has a clean font. Next, check the rate type. Is it the ongoing APY or a promotional APY? Does it expire after 3 months, 6 months, or a year? Does it require a new customer bonus, payroll deposit, debit card spending, or a minimum monthly transfer? Calculate the rate you will actually receive, not the rate they printed in big friendly numbers. Then check balance caps, fees, and minimums. An account paying 5.00% on the first $2,500 and nearly nothing after that is not the same as an account paying 4.25% on your whole $10,000. No monthly maintenance fee should be the default expectation. No fee because your balance dipped below a weird threshold. No punishment because you treated savings like savings. If the account needs constant babysitting, it is not a good emergency account. It is a part-time job with worse benefits. Then check transfer timing. Before moving your main emergency reserve, do a test transfer. Move $50 from checking to the new account, then move $50 back. See how many business days it takes. Check whether weekends delay it. Check daily transfer limits. Check whether new accounts have temporary hold periods. The time to learn your emergency fund has a 5 business day delay is not when your car is making a sound that should not legally come from a car. And understand taxes. Bank interest is usually reported on Form 1099 INT and is generally taxable as ordinary income. If your account pays you $450, you do not necessarily keep the entire $450 after federal and possibly state taxes. But taxes do not turn $38 into a strategy. If you earn $450 and pay some tax, you still likely keep far more than you would have earned in the near zero account. Now bring Lauren back. She does not move her whole $10,000 into the highest yield account from a random ad. She starts with the stack. She keeps $1,000 at her regular bank because the aging dog, the car, and life in general have already proven they enjoy surprises. Then she moves $9,000 to an FDIC insured high-yield savings account, paying a competitive APY with no monthly fee, no minimum balance requirement, and normal ACH transfers. Before she moves the full amount, she sends $50 in and $50 back.
It takes 2 business days, not instant, but manageable. She turns on two-factor authentication, saves the bank name, checks the FDIC listing, and reads whether the rate is promotional. Very glamorous stuff. Truly the finance equivalent of changing an air filter. Over a year, if Lauren keeps $9,000 in an account averaging around 4.25% and $1,000 in the old bank buffer, she might earn roughly $386 before taxes instead of about $38 on the whole balance at 0.38%. That is not the full $462 gap because she intentionally kept some instant cash at the old bank. And that is the point. The best structure is not always the maximum spreadsheet answer. It is the answer you will actually use when life gets rude. If she kept the full $10,000 in a competitive insured account averaging around 4.5%, the interest would be roughly $450 before taxes. Not a jackpot, not a lifestyle transformation, just money that was already available in the system, except the default account was eating the difference. And this is why the phrase safe account needs a second question. Safe from what? Safe from market loss? Good. Safe from bank failure within insured limits? Good. Safe from you being unable to access it? Also important. But safe from underpayment? That part matters too, because inflation already makes cash work hard enough. Here is the clean framework. Keep enough in checking for normal bills and a cushion so you do not overdraft. Keep a small instant emergency buffer at your existing bank if same-day access helps you sleep. Move the main emergency reserve to a federally insured high-yield savings account, insured credit union account, or insured money market deposit account that has a competitive ongoing APY, no monthly fee, no silly requirements, and transfer timing you have tested. Use T-bills or CDs only for money with a clearer timeline or for cash above your core emergency layer, not for the dollars you might need this week. Review the rate a few times a year, not every morning like you are tracking a sports score. If your account falls way behind the market for months, move again. If another bank offers 0.10% more but adds hoops, maybe do nothing. The point is not to become obsessed. The point is to stop being the easiest customer in the building. And if you are wondering how much effort this actually takes, the answer is usually less than one annoying customer service phone call. Open the account. Verify the institution. Test the transfer. Move the main reserve. Set a calendar reminder. Save the tax form when it arrives. That is it. You did not save that money because you had nothing better to do. You saved it because a layoff, medical bill, car repair, rent increase, family emergency, or one stupid broken appliance can turn a normal month into a financial cliff. Your emergency fund is peace of mind, but peace of mind does not require accepting a terrible rate. Check the APY. Check the insurance. Check the transfer time. Check the fees, caps, and promotional fine print. Then decide what needs to stay instant and what can move to a better insured cash account. That one decision may not make you rich, but it can turn 38 sad dollars into a few $100s a year. And when the whole point of an emergency fund is to give you options, recovering $300, $400, or about $450 is not a small technical improvement. It is one more bill covered, One more repair handled. One more month where the bank does not get rewarded for your silence. Your emergency fund should protect you. It should not be a quiet annual gift to a bank that hoped you would never check the interest line.